Okay, students, before we start our first live revision class, I just want to know, can you quickly share with me how many lectures each one of you have seen so far? How many lectures, please? You have to write in the chat box to reply. 5, that's excellent. 5 is excellent. 29, that's great. What about others? Okay. Okay, one more thing. Please reply, give me answer on this also. Have you people also received the short notes of SBR? Within 91 pages, we have covered SBR. Have you people received? Yes. No. Yes. Okay, after the class, I'll ask the admin to share those notes in your WhatsApp, respective WhatsApp groups. Okay. So after the class, admin will share SBR short notes as well. The objective of SBR short notes is not the replacement of your actual detailed notes, but the objective is so that at least what are the main points which you first understand, and after that you need to memorize them as well. The short notes will really help you. And since it is the just first class of our June 25 session, so first two classes, they will not be long, around they will be 40 to 45 minutes, but after that classes duration will increase. They will remain once a week, but duration will definitely increase. And you will see, inshallah, later on, we'll start discussing the past papers as well. So let me share. Okay, okay. I hope everyone can see this OneNote. IAS 16, that's the today's, I would say, IAS, which we need to revise. But in the next class, you will be, inshallah, we'll be revising more than one IAS. There will be 2 to 3 IASs. IAS 16, property, plant, and equipment. Number one, when we say property, plant, and equipment, so we know that property, plant, and equipment means tangible non-current asset having useful life more than 1 year. Tangible non-current asset having useful life more than 1 year. Property, plant, and equipment is initially recorded at cost. Very important point. Initially, we record property, plant, and equipment at cost. When we say initially we record property, plant, and equipment at cost, so it also includes if there is any dismantling cost at the end of the useful life of the asset, then we also include the present value of dismantling cost into that initial cost. Subsequent expenditure on non-current asset may be capitalized if it enhances the economic benefit of asset. For example, adding a new wing to a building. So obviously now you'll be getting more economic benefits. Simply it's a capital expenditure, so it will be capitalized. Replaces part of an asset that has been separately depreciated, has been fully depreciated. For example, furnace that requires new linings. Basically, when we are replacing part, so obviously when fully depreciated asset is replaced with the new one, so new one will be capitalized. Replaces economic benefit previously consumed. For example, a major inspection of aircraft will be capitalized. Assuming you are dealing a question in the exam and that question relates to a company which is running aircrafts, that's an airline. And assuming It is the requirement of Civil Aviation Authority that after every 3 years, there will be a major inspection of the aircraft, and that will cost, assuming, $2 million. So if this is the scenario, then that 2 million will be capitalized and it will be depreciated over 3 years. Another thing, the asset is depreciated over its useful life. When we say useful life, student, useful life means, for example, your company has bought a property, plant and equipment, okay? And your company is estimating that we will utilize that asset for 5 years. Then the useful life is 5 years. Major inspection will be depreciated over its own duration. For example, if that major inspection will be carried out after every 3 years, then it will be depreciated over 3 years. This 2 million will be depreciated over 3 years. Is this clear now, Salman? Okay. So useful life means how many years your company wants to utilize that asset. Now you need to understand one thing here. What is that? For example, your company bought a property, plant and equipment in 2025, and your company has estimated we will use this asset for 10 years. Now there is a possibility that after 2 years, your company says, no, instead of 10, we'll be using it only 5 years. Or your company, after maybe 2 or 3 years, your company says, no, instead of 10, we'll use this asset for 15 years. The question is, if there's a change in the useful life, change in the useful life is treated as a change in estimate. And change in estimate is always applied prospectively, not retrospectively. So if there is a change in the useful life of asset, it is applied prospectively, not retrospectively. Simply when we say prospectively, it does not have any change in the past. The change of useful life will be from the present onwards. So if there's a change in the useful life, it is treated as change in estimate. Another point, when we say depreciation, then according to IAS 16, basically depreciation is the systematic allocation of depreciable cost over the useful life of the asset, over the useful life of the asset. So when we say depreciation, then IAS, according to IAS 16, depreciation is the systematic allocation. Now, student, please try to understand. When we say systematic allocation, according to IAS 16, property, plant and equipment, systematic allocation means the depreciation method should match with the pattern of economic benefit which you will be getting from the asset. Repeat. When we say systematic allocation, it means depreciation method should match with the pattern of economic benefit which your company will be getting by using the asset. For example, if your company says that more or less we'll be getting the same benefit every year, student, if more or less we are getting the same benefit every year, can I say then you will be using the straight line method? More or less same benefits every year, go for straight line method. If company estimates no, If company says initially we'll be getting more benefit, later on we will get less benefit. If this is the case, can I say reducing balance method? So let me repeat. When we say systematic allocation means simply depreciation method should match with the pattern of economic benefit. If company says more or less we'll be getting the same benefit, go for a straight line. And if the company says no, initially we'll be getting more benefit, later on reduced benefit, go for reducing balance method, because in reducing balance method, what happens? Initially, in earlier years, you will be having more depreciation, and later years, you will be having reduced depreciation. What are the possible examples? Assuming if there is an owner-occupied building, owner-occupied building means in which we are carrying out normal business operations. So obviously from that building, more or less we'll be getting on average, we'll be getting the same benefit every year. So it is logical to depreciate that building by using straight line method. But on the other end, we are having plant and machinery which we are using in the production. Normally, what happens in case of plant and machinery when it is new, earlier plant and machinery, they give us more benefit, and obviously later on they give us less benefit. So for that plant and machinery, it's better to go for reducing balance method. Another point. If now it's a very important concept which I'm discussing right now, please listen it carefully. If after some time, if pattern of economic benefit changes, then you have to change the depreciation method. Now the question is, after 2 or 3 years, if pattern of economic benefit, let's assume it changes, I have to change the depreciation method. Change in depreciation method is treated as change in estimate. And change in estimate is always applied prospectively. So when there's a change in the pattern of economic benefit, then you should be changing the depreciation method. So depreciation is a systematic allocation of depreciable cost. Depreciable cost. I will take the cost minus residual value. So depreciable cost is simply cost minus residual value. It could be cost, it could be revalued amount minus residual value. If, for example, we are following the revaluation model, then instead of cost, we will be writing revalued amount minus residual value. But according to IAS 16 only, depreciable cost should be depreciated over the useful life of the asset. Now come here, please. The depreciation method and useful life of an asset should be reviewed at the end of each year. That's very important point, students. The depreciation method and useful life of an asset should be reviewed at the end of each year. If you come across a question where examiner says that one of the director has suggested, instead of reviewing depreciation method and useful life at the end of each year, let us review after 3 or 4 years, then obviously it is against IAS 16. If an asset has parts with different lives, for example, building with a flat roof, the component parts of the asset should be depreciated separately. The logic behind this is it's a concept of simply componentization. In componentization, student, what happens? Each component is having a different useful life. So obviously, when each component is having a different useful life, so we cannot depreciate them, all of them at a same life. So that is why each component where is having a different useful life, then each component will be depreciated separately. Until unless, if some of the components, assuming if they are having same useful life, then you can obviously depreciate them together. Otherwise, the concept of componentization says where each component is having a different useful life, then it will be depreciated separately. For example, let's take an example of an aeroplane. Obviously, in case of an aeroplane, engines, they will have a different life, and normally you can say engine life will depend on the flying hours. Exterior structure of the aeroplane will have a different useful life. Interior cabin fittings will have a different useful life. So simply we will apply the concept of componentization, and each component which is having a different useful life will be depreciated over their own life. Another thing, IAS 16, property, plant and equipment, we know that initially property, plant and equipment is measured at cost. But subsequently, IAS 16, property, plant and equipment, subsequently, not initially, okay? Subsequently, IAS 16 gives you two choices. Subsequently, you can follow cost model. You can also follow revaluation model. Repeat. Initially, we know that property, plant and equipment is kept at cost. Subsequently, there are two options. IAS 16 gives you the cost model as well as revaluation model. Okay. Now, important concept. If your company wants to go towards revaluation model from the cost model, or from the revaluation model to the cost model, the very important point is which model should we follow? That is your accounting policy. Which model should be followed? That is accounting policy. Whenever the word accounting policy comes, accounting policy means where you have a right to choose. Accounting policy. A very simple interpretation of accounting policy is right to choose. So your company has a right to choose either to go for cost model or to go for revaluation model. Okay, now important concept is whichever model company wants to opt, then you have to make sure all the assets of the same class will have the same model. It is not possible for us to plant, both are used in the, let's say, production process of a company. I cannot keep one plant at cost, another plant at revaluation model, not allowed. All same class assets, they will have the same model, either cost model or revaluation model. Accounting policy means right to choose. Okay, now, if subsequently, let's say, company changes the accounting policy from cost to revaluation or revaluation to cost model, the main concept is change in accounting policy is always applied retrospectively. Retrospectively means as if you were always using the new policy. So change in accounting policy is always applied retrospectively. Now come here, please. Revaluation of property, plant and equipment. Revaluation to fair value is optional. It's obviously IAS 16 has given you two accounting models. One is cost model and another is revaluation model. It is your accounting policy. That is why revaluation model to fair value is optional. If one asset is revalued, all asset in that class must be revalued. Revaluation gains are credited to other comprehensive income unless the gain reverses previous revaluation loss of the same asset previously recognized in profit and loss. Now, what do you mean by this? Come here. Assuming, just an example, okay. Let's say there's a property, plant and equipment. Cost is 100 million. Useful life, 5 years. 1/1/2025. We are depreciating, let's say there's no residual value. We are depreciating this on a straight line method. So depreciation expense for the first year is 100 divided by 5, it is 80. It is 20. December 2025. Carrying amount of property, plant and equipment will be 100 minus 20, it is 80. Now, assuming December 25 is the first time that company wants to revalue this property, plant and equipment. Repeat. December 25 is the first time the company wants to revalue this property, plant and equipment. Before revaluing the asset, first you have to calculate net book value. After that, that net book value, that carrying amount will be compared with the revalued amount. If you want to revalue the asset, and let's say it is the first time we are revaluing the asset, first time. And let's say examiner says the revalued amount is 70 million. Instead of rise in the property plant and equipment value, there's a decrease. If you are revaluing the property, plant and equipment first time, and then instead of rise in the value of the property, plant and equipment, there's a decline, that logically that decline of 10 million, this is technically your impairment loss. Let me repeat. Here we were revaluing the asset first time. Instead of rise in the value, we have seen a decrease. So logically, there is a 10 million loss, and this is impairment loss. It will go to P&L. So when you are revaluing the asset first time, instead of increase in the value of asset, if there is a decrease first time, that is very important. Then it is your impairment loss. This impairment loss will go to profit and loss statement of comprehensive income. Okay, now after impairment, of course, we have to depreciate the asset over its remaining life. After impairment, we will be depreciating this asset over its remaining life. Okay, now December 26. After the impairment loss of 10, property, plant and equipment becomes 70. Depreciation of 2026 will be 70 divided by 4. Initially, useful life was 5 years. Then at the end of 1 year, there was an impairment loss. Now the remaining life is 4 years. So there's a depreciation of 17.5. 70 minus 17.5. I'm getting 52.5. Now, let's assume December company follows revaluation model and is following the revaluation model. And December 26, the value is increased. Examiner says revalued amount. Let's say the recoverable amount, which we'll be discussing in IAS 36, don't worry at all. Recoverable amount is 90 million. Okay. So the property, plant and equipment, which is having and this is December 26, okay. The property, plant and equipment, which is having the carrying amount 52.5, it is having a revalued amount, recoverable amount, let's say 90 million. Okay, fine. Now the question is, what should be done with the difference of 52.5 and 90? The difference 90 minus 52.5, the difference is 37.5. Now, entire 37.5 cannot be treated as a revaluation surplus. Entire 37.5 cannot be treated as a revaluation surplus. It cannot be taken, the entire 37.5 cannot go to OCI, other comprehensive income, because the asset in which we, here now we are noticing the value has increased. Previously, we have recognized a loss in that asset. So How to incorporate that 37.5 is very simple. First, you have to calculate the carrying amount without any impairment loss. December 2026, if there wasn't any impairment loss, so initial cost of the property, plant and equipment, we know that it is 100 million. Then depreciation of 2025 is 20. Then depreciation of 2026 will be 20 again. Can I say if there wasn't any impairment loss, then on December 2026, the carrying amount would have been 60. Repeat, without any impairment loss, the carrying amount would have been 60. So the maximum reversal of impairment loss will be the difference of 60 minus 52.5. 60 minus 52.5, which is 7.5. So 7.5 is the maximum reversal of impairment loss, which actually will go to P&L. And any rise which is over and above 7.5, that will be treated as a revaluation surplus. So from that 37.5 increase, 7.5 is a reversal of impairment loss. Remaining 30 will be the revaluation surplus. Now, the double entry will be on December 2026. Debit and credit. Property, plant and equipment, let's say we'll debit this with 37.5. Reversal of impairment loss. Reversal of impairment loss, which will go to profit and loss, 7.5. Revaluation surplus, which will go to OCI. Revaluation surplus, that will go to OCI. How much it is? 30. Now, please try to understand. Now, the question is, sir, we charged the impairment loss of 10 million to the income statement. In the December 25, we charged the impairment loss of 10 million to the profit and loss, but here the reversal which we have taken to the P&L, it is 7.5. We can see loss which we charged to the P&L in December 25, it was 10. Here when we are reversing, so we have taken a reversal to the P&L only 7.5. So logically, why a reversal is 7.5, why it is not 10? There's an answer to that also. Please try to understand. After impairment, student, you can see that after impairment, the depreciation in 2026, it is 17.5. If there wasn't any depreciation, then there wasn't any impairment, then depreciation would have been 20. So please try to understand what is the main logic, why we cannot see the reversal by 10, why there's a reversal by 7.5. The logic behind that is after impairment, your depreciation has reduced. We have charged the depreciation 17.5 instead of 20. So you can see there's a decline in the depreciation after revaluation, which is 2.5. Now try to understand. Instead of taking depreciation expense to the P&L 20, instead of 20, we have taken 17.5. So logically, with the difference of 2.5, logically your profitability has increased. Just imagine if there wasn't any impairment loss, we would have charged 20 million in 2026. Now, due to impairment loss, instead of 20, we have charged 17.5. So we charge 2.5 less depreciation. So technically, when you are charging less depreciation, it means your profitability has increased by 2.5. And your profitability has also increased by the reversal of impairment loss by 7.5. So you can see that logically, profitability has increased by 10 million. So why we cannot see the reversal of 10? The logic is because after revaluation, depreciation amount has reduced. Another point is whenever there's a reversal of impairment loss, maximum reversal of impairment loss is the difference of carrying amount which you are having in your books. And second is the carrying amount if there wasn't any impairment loss. So this is the maximum reversal. Now come back, please. Revaluation gains are credited to other comprehensive income unless the gain reverses a previous revaluation loss of the same asset, which was recognized in P&L. Revaluation losses are charged to the statement of P&L unless the loss relate to the previous revaluation surplus, in which case it should be charged to OCI. Simply, if you are revaluing the asset first time if there's a revaluation loss, logically that is impairment loss and that will go to P&L. But if there is already a revaluation surplus in the carrying amount of your property, plant and equipment, and in the future, if value reduces, then it will reduce your revaluation loss. What do you mean? What is the meaning of this? For example, there's a property, plant and equipment. Let's say the carrying amount is 100 million. An examiner says including revaluation, let's say 10 million. And this carrying amount is given us on December 2025. If examiner says revalued amount, recoverable amount, for example, is 95 million. So obviously property, plant and equipment from 100, it will come to 95. We have to recognize a loss of 5 million. Now this loss of 5 million will not be charged to P&L because previously this asset was revalued and there's a revaluation surplus of 10 million. Now what are we going to do? Debit and credit. Revaluation surplus. OCI will be debited by 5. Property, plant and equipment will be credited by 5. Now this 5 will not go to P&L. So if there's already a revaluation surplus in the carrying amount of property, plant and equipment, and let's say the revaluation loss comes, first you have to eliminate the revaluation surplus. If your loss is more than that, then any loss which is over and above the revaluation surplus, that will go to P&L. For example, if here the loss was 12 million, then we first would have debited revaluation surplus by 10, then 2 we have, then obviously remaining 2 is your impairment loss, and that will go to P&L. Now come here. Revaluation losses are charged to the statement of P&L unless the loss relates to the previous revaluation surplus, in which case it should be charged to OCI. The revised carrying amount is depreciated over the remaining useful life of the asset. An entity may choose to make a reserve transfer of the excess depreciation arising from a revaluation. This is taken from revaluation surplus to the retained earning. That is very important. An entity may choose. Students, whenever the word choose comes, it means what? Is it your estimate or accounting policy? Accounting policy, great. This is an accounting policy. Wherever the term comes that you have a right to choose, accounting policy. Now, student, please listen. After revaluation, it is up to the company. If you want, you can realize the revaluation and slowly and gradually you can transfer the revaluation surplus to the retained earning. Now, what is the meaning of this? Transferring the revaluation surplus to the retained earning? Assuming property, plant and equipment carrying amount is 100 million. December 25. And let's say examiner says remaining useful life is 5 years on December 25, okay? And there's a revalued amount of 120 million. The revalued amount is 120. And company follows revaluation model. Okay. So we have to recognize the revaluation of 20 million, simply debit and credit. Property, plant and equipment debit by 20, revaluation surplus. That will go to OC, other comprehensive income, 20. Now in December 2026, 120 million divided by 5 will have the depreciation. 120 divided by 5. So 120 divided by 5. Students, I'm getting depreciation 24 million. Okay. Now in December 2026, it is up to the company either slowly and gradually transfer that revaluation surplus to the retained earning, or let it remain in let it remain 20 as 20 as your revaluation surplus. If company chooses that we will slowly and gradually transfer the revaluation surplus to the retained earning, so what is the double entry of that? 20 divided by remaining life, which is 5, I'm getting 4. Debit and credit, simply revaluation will be debited by 4. Retained earning will be credited by 4. Very important point is, now revaluation surplus will be debited, OCI will not be debited. When you are transferring your revaluation surplus slowly and gradually to the retained earning, your double entry will be revaluation surplus debit, retained earning credit. That will not impact your OCI. Transfer of revaluation to the retained earning is simply revaluation debit, retained earning credit. And one more thing. In SOFP, statement of comprehensive income, in equity section, instead of writing revaluation surplus, we also use another terminology. That another terminology is OCE, other component of equity. So basically, when we are realizing the revaluation surplus and we transferring that to the retained earning, your OCE, other component of equity, or you can say revaluation surplus, will be debited, retained earning will be credited. The main concept is, when we are realizing the revaluation surplus, it is not necessary to realize, number one. Number two, if you are doing this, it is going to be your accounting policy. Number three, when we are realizing the revaluation surplus, so it will be directly transferred to the retained earning. It will not go to the P&L, number one, and it will not affect the OCI. So realization of revaluation entry will be simply revaluation surplus, or you can say other component of equity debit, retained earning credit. That is the meaning of realization of a revaluation surplus. Now, just one interpretation. Obviously, if you are transferring revaluation surplus to the retained earning, overall your equity will not change, because revaluation is an equity item which is debited by 4. It means revaluation is reduced. But on the other end, retained earning has increased. So overall equity will remain same. But you can put one interpretation. What is that? You can say that when company is transferring revaluation surplus to the retained earning, then you can say that company is actually converting undistributable reserves to the distributable reserves. Repeat. When company is transferring revaluation surplus to the retained earnings, so it has an interpretation as well. That interpretation is company is actually transferring. And obviously, I cannot distribute a revaluation surplus, but we can distribute retained earning, and we do distribute retained earning. So you can just put one interpretation that company is actually converting non-distributable reserve to the distributable reserves. It cannot be recycled to P&L. It cannot be recycled to P&L means instead of retained earning. For example, recycling means if I write profit and loss here, So we are actually, what are we doing? We are slowly and gradually recycling revaluation from OCI to the P&L. It is not allowed. Recycling means one thing which was in OCI, and after some time, the same thing you can see in the P&L. That is recycling. So revaluation cannot be recycled to P&L. It can only be transferred to the retained earning. I hope it is clear now. Okay. So revaluation surplus cannot be recycled to P&L. Simply revaluation slowly and gradually you can transfer to the retained earning if that asset is a depreciable asset. Or second, if you are not doing this, then don't worry at all. At disposal, entire revaluation will be transferred to the retained earning. Then we have IAS 20 will, but today we have to just stay with IAS 16. I just want to discuss one or two more concepts regarding IAS 16. Okay, in IAS 16, property, plant and equipment, you should know one more thing. What is that? Owner occupied property is a property in which we are carrying out normal business operations. So obviously in which we carry out a normal business operation on that property. You will apply IAS 16, property, plant and equipment. On that property, we apply property, plant and equipment. Owner occupied property means where we are carrying out normal business operations. Now you need to know one more thing. What is that? If there's a company which has, let's say, properties, and that company gives those properties on rent, number one. But they give those properties on rent only to their employees. Only to their employees. And company charges rent lower than the market value. For example, market value of the rent is 20,000 and company is assuming charges rent 10,000. Okay. Now, number one, company says we want to treat these properties as investment properties, number one. And number two, company says the market value of the rent is 20. We are getting only 10,000 rent from our employees, let's say. So the difference of 20 and 10, we want to charge the notional cost to the income statement because we are not getting 20, we're getting just 10. Number one, when you have properties, but which are only available to your employees, not to the general public. So logically, those properties, they also fall in property, plant and equipment under IAS 16. They are not your investment properties. Second, instead of charging the rental 20, you are charging rental 10. So the difference of 10, you cannot treat notional. The difference of that 10,000 difference cannot be charged to the income statement at the notional cost. Not allowed by IAS 16. So properties are only available to your employees. So IAS 16 is applicable. Only your rental income is 10,000. The difference of 20 and 10 cannot be charged as notional cost to the income statement. One more thing. There's a property, plant and equipment. We have a cost model under IAS 16. We know that. And we do have a revaluation model. And we know that it is company's policy to follow whichever model they want to follow. Okay, now try to understand. It looks nice that we are revaluing property, plant and equipment. We are following the revaluation model. But try to understand. If the company goes for revaluation model, plus the revaluation comes, of course, if the revaluation comes, then property, plant and equipment value will increase. If the property, plant and equipment value will increase, then depreciation expense will increase. Due to increase in depreciation expense, profitability. reduces. Obviously, I said company follows revaluation model plus they have recognized the revaluation and revaluation is upward. The value has increased, then depreciation will increase. Due to increase in depreciation expense, profitability will reduce. If the profitability reduces, let's say I'm calculating return on capital employed, ROC, profit before interest and tax divided by capital employed into 100. Logically, the capital employed is equal to the total equity plus debt. This debt is a long-term debt, or you can say that total assets minus current liabilities. Now try to understand. If the company goes for revaluation model and the revaluation comes as well and there's a rise in the value of property, plant and equipment. Due to that rise, your depreciation expense will increase. So obviously your PBIT will reduce. Plus due to revaluation surplus, can I say equity increases? Due to revaluation surplus, your equity will increase. Can I say when the equity will increase, logically capital employed will increase? Your return on capital employed, ROC, will reduce. Are you getting this point? It means that you can say that if company goes for revaluation model and the revaluation comes and it's an upward revaluation, so logically it will not have a good impact on number of ratios. You can see that your return on capital employed, instead of increase, it has decreased. So it means that if I'm evaluating the performance of a company, so you can say that revaluation model basically is going to deteriorate at least some of my profitability ratios. Is this clear to everyone? Student in the comments. Yes or no? Okay. So it means that when I'm evaluating a performance of the company, so I have to check the revaluation model. Is it encouraging us or discouraging us? Of course, revaluation model does not encourage us because my profitability ratios are not increased due to this. Actually, profitability ratio, they are going towards declining side. So students, that is all for today's class. It's a first class. That's why I don't want to take it a long class. But in the next class, you can see that in the next class, we'll be discussing number of IASs like 20, 23, 40, 38. But let's do one thing. We will try to discuss in the next class IAS 20, 23, 40, 38. If we get time, then we'll go for 36. If we get time. Otherwise, we'll be doing only 20, 23, 40, and 38. And later on, students, don't worry at all. After a few classes, we will start revising, we'll start the discussion of the past papers as well. But before doing any past paper, first that past paper will be shared with you at least 3 to 4 days before the class, so that you will be having around 3 to 4 days to attempt that question. After that, we'll discuss. So is there anything you want to ask, student? We are having last 2 minutes before I end the today's class. I hope everyone has enjoyed today's class. Please, any comments? You want to say anything? You are most welcome. Before I end the session. Okay, students, do give the feedback of today's class in your respective groups, because your feedback, of course, gives us a motivation. And So, Shayan, you can message me after the class in case of any queries. So, do give me the feedback on today's class in your respective WhatsApp group. Okay, students. Number I can share directly 0333 322 3355. You can directly contact me, no issue at all. Okay, students. So see you all inshallah in the next class. Do give the feedback on today's class. Okay. Thank you.